Good morning. My name's Marcus Malika. I'm with the Note Consultants, and I've been going to a lot of real estate note investing conferences over the years, and I get a lot of questions with regard to real estate notes, creating partials, and who gets what if the note pays off early. And many of you probably know me as the T-value guy at places like the Paper Source, Noteworthy, Note Investor Summit several years ago. And I've also done numerous webinars on this topic of creating partials, creating workout scenarios, and things of that nature with regard to real estate notes. So I've been getting this question a lot, and I've said that I'm going to create a video for this. And what I'm going to do is I'm going to make this video as a two-part series, and basically showing you how we create a note. You have a full note, say 30 years, and then maybe you sell a partial for, let's say, 5 years or 60 payments. And then in the second part of this video, we will show you that if the note pays off before the 5 years, let's say 3 years, who gets what? So if I have a property that I sell with owner financing, I create a 30-year note. I might sell you 5 years of that note for cash flow, and you have that 5 years of the note. After the 60 payment, the note comes back to me as the note holder, and I have the remainder of that note, or what we might call the tail end of that note, that I get the remainder of those payments. After that 5 years, I could turn around and sell another 5 years of payments for another investor. And what you're going to see, and I like the term that the magic of partials here, is how this works for me as a note holder and increasing my yield by doing this, and also providing a good opportunity as an investment for somebody else that wants a above average return on their money. Maybe it's money they have sitting in a retirement account, maybe sitting in a bank account, maybe they're nearing retirement or in retirement and they just want some cash flow rather than just letting that money sit idle. So let me take you to just a little summary, share my screen here on a summary of what this note is. Okay, so here, basically, there are different schedules with regard to creating these partials, and it's good to understand the terminology here. And you have what's called Schedule A, which is the payor's note, or it's what the borrower is actually paying. So we sell a property, create a note, sometimes two notes, and that would be what's called Schedule A. That's what that borrower is paying. It's got an interest rate on that note that they're paying. And then when we sell a partial, we create that partial schedule amortization of that principal amount that we sell, let's say for those 60 payments. So there's an amortization schedule that goes for that, and it basically shows what that investor is getting for that partial. And we call that Schedule B, as in boy. And what I want to make the distinction of here in this first video is Schedule B, which is the partial note at the same interest rate as Schedule A that the borrower is paying. There's another schedule if I sell this partial at a discount to, let's say, another note investor who wants a 12% return on a note that is actually at 10%. That would be called the basis schedule, because that schedule is at the rate, which is the yield that that investor is getting. I could also sell that partial at an 8% or 9% return to somebody else that just wants the cash flow. Maybe a retiree is completely fine with having an 8% return on their money, and I can sell that partial to them at an 8% return, and that also would be the basis schedule. Now, the question often asked is, well, which schedule is it that I pay that investor on if the note pays off early? Is it Schedule B, or is it the basis note? And that really is a matter of what the agreement is with you and that person that buys that note from you. Okay, but it's good to understand the distinction between those schedules, those amortization schedules, and that's what I'm going to show you here in this first part video. So let's go down here and we'll call this schedule, schedule B. Let's make this a little bigger so you can see it. All right, and then we will have here what we call investor basis schedule. And this is going to be, in my terms, Schedule D. And you will see between the second part video that we do, the Schedule C, and that's the remainder interest. So for example, I create the note on a seller financing for property I sell you a partial, which is the Schedule B. Well, the Schedule C is what we call remainder interest, and that's the note holder. In this case, it would be me. I don't always have to be the homeowner in that case that sells the property, but Schedule B is the original note holder who sells the partial, Schedule C. All right, so all right, so the partial Schedule B is at the note rate, in this case of 10%. We're going to do, I'll show you a couple scenarios here, but let's just say the basis schedule is at the yield of the investment. Okay. For 5 years or 60 payments. Right, and this would be the same for both cases. All right. So this is where we want to make the distinction here between Schedule B and Schedule D. All right, what I'm going to do is I'm going to take you to my trusty T-value amortization software to show you how I create these amortization schedules. All right, so I've got this laid out for you here as the partial for, I'm sorry, this is Schedule A here at the 10%. And basically the way I do this, just to show you quick, at T-value, I can solve for any variable. So I solve for my payment amount here. And I get the payment of the $1,228.60. So that is Schedule A. This is what the borrower is paying. It's the full amortization that borrower is going to pay, potentially for 30 years or until they sell the house or refinance the house. Maybe in several years they'll refinance to get a lower rate. Right? So that shows breakdown of the interest and principal and balance information for the borrower. All right, so the scenario here is we sell 60 payments. What I want to do is calculate what the value of those 60 payments are. And this is going to be at the rate of the note, Schedule A. Let's redo that here. Might have a slow internet. All right, so the value of this partial, the 60 payments that I'm going to sell at 10% is $57,824. That's the value of the partial. Okay, now I can sell that partial with a yield of 10%, 57,000. I can sell that partial with a yield of 12% for 55,000. Or I can go in the opposite direction and sell it to somebody for, let's say, an 8% return for 60,000. So anywhere from 55 to 60,000, I can sell that 5 years of payments. That's the cash that I will get for that. the investor in return is going to get, they own whatever that value is, and they get 60 payments of 1228.60. After payment 61 will come back to me as the note holder. So the magic of partials is what I want to show you here. Let's put Schedule A back in there. And this is pretty amazing. And a lot of people don't really know that you can do this. Let's put this full amount in here. Oops. All right, let's take a look at that amortization again. All right, so the borrower is paying here. Here's the number of payments we go through. All right, let's go down here. Let's say that that investor receives all 60 payments. Okay, after 60 payments, here's my balance. $135,000 is my balance, 135,204. Okay, so let's take a step back here. I sold that partial of 60 payments to somebody for $55,000 to $60,000. 5 years later, I get that loan back, that note back, with a balance of $135,000. It basically cost me $5,000 off this note to give somebody else 60 payments for a return of anywhere from 8 to 12%. That loan comes back to me. I still own that balance of $135,000. I could turn around and sell another 60 payments. Okay, let's go down, take a look again. Now, granted, I'm not getting these payments for 5 years or 6 years. And for somebody like myself, I'm 50 years old, and I'm, if I want to retire at 60 or 65, maybe I don't need that cash flow right now. Okay, I'm going to create these scenarios and opportunities for other people to invest for the cash flow. And also, I have what's called the tail end of these notes, which means years down the road, those cash flows are going to come back to me. Or what you'll see in the next part of this series is that the note pays off early, and then I get paid that remaining balance at whatever point that is. So let's say it goes, so say I sell another 60 payments. So now I got 10 years of payments that I sold. And maybe I sold each one for $55,000. So I've made $110,000 in that 10-year period, basically cash. That loan comes back to me with $127,313 as a balance. Okay, I basically made $110,000. I still have $127,000 to collect. The magic of partials. All right, well, I'm available for anybody that has questions on this. I will also be at the Paper Source this year, April 27th through the 29th, as the T-Value guy with Time Value Software. But you can reach me. With any questions. You can email me. At thenoteconsultants@gmail.com. See if I can get this a little bigger for you to see. All right, thanks again for watching. Please call or email me with any questions. Otherwise, maybe I'll see you at the Paper Source. Thanks.